This Week in Economics on WBRN Radio and on the Bostonred Network for the 15th of April 2018, which would normally be Income Tax Day, but since it's on a holiday, Monday will fall the day that officially many people would file their income tax returns, although most have already filed, or they will ask for extensions, one of the two. Very interesting situations we have now with the tariffs, and we'll talk a little bit about that. We have the Consumer Price Index, came out from the Bureau of Labor Statistics on the 11th of April. We were looking to see what statistics we would have. Some weeks we have more than others, and this week we'll have enough to make a quote-unquote report at least, and we'll talk a little about the impact of the bombing of Damascus, Syria, in terms of costs. We have that from Fortune magazine, I believe it is. Anyway, we'll look at some of the teachers' strikes and other things in this report. And so on we go here. The Consumer Price Index for March for all urban consumers was 1/10%. In March, seasonally adjusted basis, rising 0.2% in February. And the Bureau of Labor Statistics reports that over the last 12 months, all items in the index rose 2.4% before seasonal adjustments. The decline in gasoline index more than outweighed increases in the index for shelter, medical care, and food to result in the slight seasonal adjustment decline in all the items indexed. The energy index fell sharply, mainly due to the 4.9% decrease in gasoline index. The index for food rose at 1/10% over the month, with the index for food at home and food away both increasing. The index for all items less food increased 0.2% in March. The same increases in February, so we see some creeping up of prices here. The all indexes rose 2.4% for 12 months ending in March, the largest 12-month increase since the period ending March 2017, and bigger than the 1.6% average rate over the past 10 years. Now, that would include the Great Depression. So we have some interesting things going on here, with inflation actually going up due to pricing. The index for all items, less food and energy, rose 2.1%. It's the largest 12-month increase since the period ending in February of 2017. The energy index increased 7% over the past 12 months, and the food index at 1.3%. So we look at some of these are out here. Let's see, we can all items, we talked about that. 0.2%, 1/10%. This is all items that are food, 1/10%. We're sort of going down here. Food away from home increased in March at 1/10%. It was 0.2% in February. Energy and gasoline fell a negative 4.7. Energy commodities, sorry about that, and 2.8, gasoline 4.7, got that right. And fuel oil, we don't hear about that much, negative 0.7%. Energy services, a negative 0.2. Utilities, just a negative there. Commodities, Energy commodities, 1/10%. New vehicles, just a zero there. Used cars, a negative 3/10. Apparel at a negative 6/10. Medical care commodities, 1/10. Services, less energy at 3/10. Shelter at 4/10, and transportation services at 2/10, and medical care services at 5/10. That would have been in March. So we started just looking at the broad overall here. The food index rose 1/10 in March after unchanged in February. The index for food and energy for the home increased also 1/10%. We found at home, also increased 1% is for the 6 major grocery store food groups rose. The index for poultry, fish, eggs increased 0.8%. And in March, after declining in February and January and February, the index for cereals and a bakery rose 0.4%, as did the index for non-alcoholic beverages, I guess that's tonic as we call it. The index for dairy and related products also rose in March, advancing 0.3%. After declining 0.3% in February. Fruits and vegetables index, this is sort of like they do it in China, declined 0.7% in March after falling 0.5% the previous month. The index for other foods at home also fell for the second month in a row, declining 0.2%. The index for food at home rose 0.4% over the last 12 months. The index for meats, poultry, fish, and eggs increased 2.1%, and the housing index were relatively flat. All 5 of the remaining grocery store food groups moved less than 1% over the last year. Energy, we've talked about energy here in March. The index fell 2.8% in March after rising 3 of the last 4 months. So that is changed. That'd be very interesting to see. We'll look a little at the energy sector here. The index for all items, less food and energy, at 0.2% in March. The personal care index increased 0.3% in March. The index for motor vehicles continued to rise, increasing 0.3%. The airline affairs index increased 0.6%. The same increase as in February. In other words, airlines are going up. The index for alcohol beverages and household furnishings and operations both increased 1/10% in March, while the index for new vehicles and recreational were unchanged. The apparel index fell 0.6% after rising each of the 2 prior months. The index for communications declined 0.3%. The used car and truck index fell 0.3% in March. Same decline as in February. Index for education and for tobacco also declined in March. The index for all other items, less food and energy, rose 2.1%. That's over 12 months. Shell index rose 3.3% over the last 12 months, a higher figure than the 2.2% average increase over the past decade, in other words, 10 years. The consumer price index for union wage earners and clerical workers increased 2.4% over the last 12 months. to an index level of adjusted. To an index a level of 243,463. For this month, the index increased 0.2% for seasonal adjustment. The consumer index for all urban consumers increased 2.2% over the past 12 months, a year. For the month, the index at 0.2 as not seasonally adjusted. The price index for April is scheduled to be released on Thursday, May 10th. So that does that part of it here. Jobless claims fall, import prices unchanged. This is from Reuters. New applications for unemployment benefits fell last week, pointing to sustained labor market. While other data on Thursday, import prices were flat in March, and a sharp drop in the cost of petroleum products. We already talked about that. Economists say a trade war between the U.S. and China could fan price pressure, push the Federal Reserve to move more aggressively in the interest rate increase. Some of the byproducts of this tariff operation, as long as we don't get into a trade war where tariffs are slapped on all sorts of goods, the Fed should maintain its slow tightening policy. That is Nuroff. He's the chief economist at Nuroff Financial Advisors in Holland, Pennsylvania. Initial claims for state unemployment benefits dropped 9,000, seasonally adjusted to 233,000. That's ending April the 7th. Economists polled, started falling to 230,000 last week. Anyway, it doesn't really matter right there. The economy created 103,000 jobs in March, fewer than in the 6 months. Well, that's part of it because the tax cut regime has started to filter through the economy. The new tax tables were out in mid-February, which means employers, most employers, probably all employers, had fully implemented those new rates to the workers, and the workers had passed it on to the economy, and that is starting to filter through. In late December, January of 2016, there was a meeting of many of the economists, including the economic advisor to John McCain in 2008, talking about the Trump economy and how it would affect economic policies, the overall economy. And at that time, we were listening there to it. It was obviously too early to predict because he had talked about many things, including the disbandment of the Affordable Care Act, known as Obamacare, would have a drastic impact on the economy. Not an unintended consequence, but a massive reduction in healthcare services. More and more medical centers in small rural markets would have closed, that have not already closed. And in certain urban centers, that would have affected Medicaid as it is affecting it now. And those kinds of things that destabilize the system. And this is one of the big problems with the regime that's there now. Their economic advisors, they do not understand the consequences. I'm not talking about unintended consequences. We're talking about the consequences of their economic policies. There were similar economic policies in the 80s under Ronald Reagan. And Ronald Reagan had some severe, what's called recessions. But the economy was much smaller at that time. These trickle-down voodoo economics, as George H.W. Bush, President Bush, said, it don't work, and it never worked. They would try it again under G.W. Bush. and G.W. Bush ended up with a depression. And this is part of the problem, that when you debate this issue with these characters, they just tend to dismiss it. But you cannot dismiss history, particularly history in a more recent event in 2008. That was the year of the Depression, and in 2009, the then Senator from Illinois, Barack Obama, took over in a catastrophic depression that had hit the economy, and the lingering effects of it lasted throughout his 2 terms of his presidency. Now some light is coming, but the new economic policies of this new regime, known as Trumpnomics, have started to further complicate things. The tax cuts, known in the political cadence as tax giveaways, have had their impact. Now the idea of the tariffs, and this is again an underestimation of the economic power of emerging nations, i.e. China. And once these things are implemented, they say, well, we had negotiated. China really has no reason to negotiate with these people, period. Because what they have done is they've already laid out their plan. They didn't do it in the back room, anything like that. 2025 to move to an internal economy. They have 1.2 billion people, and then there are other global economic relations and opportunities. They can use that, and they do not have to deal with the people in North America, period. So what this has done is 25% or whatever. The number there honestly doesn't matter. Trump could put a 50% tariff on Chinese goods. They would just leave the market. That would be the consequence of it. So therefore, there is no negotiation taking place there. There is no flexibility in this across-the-board situation there. Can the U.S. economy survive with the steel and aluminum tariffs, etc.? Yes, but there will be a price adjustments, and the price adjustments will make many things more expensive. And also these conflicts, we'll go to the cost of it in a minute here, from Fortune magazine. But all these things are feeding in here at once. And then you have the market, which some of DJ Trump's advisors says is inconsequential. That it may. But the problem is, in the present industrial, global capitalist economy that the U.S. is in, it does matter. In psychology, the market is very, very important. And there has been a call for the Fed to abandon quantitative easing a very long time. Now we have people saying that they should do it in a measured response. Well, they are going to get out of quantitative easing, no doubt. That's the buyback program. They will move out of that. But at the same time, they will raise interest rates by a quarter point, at least 3 times more this year. Because the inflation, what's happening here basically is inflation has been pinned up. Now you're going to start seeing the actual dynamics of the economy running over the Fed's 2% mandate. And part of the problem there is you get up a quarter point, 2/4 point over the mandate, but that's just pinned up. Can easily get up to 2%, towards 3%. Is not a problem, but that's just their psychology. Now, cheap petroleum, that's another problem also. The Trump administration has relied on fossil fuels to fuel some of their developmental options. And that is in places like North Dakota with the fracking, with fossil like coal in West Virginia, parts of Pennsylvania, Ohio. As the fracking part goes down, and that also goes with that, are states like Wyoming and Texas that are still somewhat dependent on petroleum. So, in other words, imports increased 3.6% in the 12 months through March, the biggest gain since April of 2017. This is from the Department of Labor here. Excluding petroleum imports, the gain was only 1/10 in March after climbing 4/10. That's relatively calm there. Import prices excluding petroleum rose 2.1% through the 12 months. It will rise more than that with the tariffs. Goods, the price of goods imported from China edged up just 1/10. There, for the second straight month, prices for imports from China increased 2/10 over the 12 months. They will increase much more than this as they are there. So this is one of the items that is happening here, and also some of the teacher strikes. Teachers were out 10 days in Oklahoma. That has an effect on the economy of rural states of that nature because the schools play a very big, important part in the index. Now we see in Indiana, teachers there also thinking about it. The state has laws to defer it, but despite that, teachers could strike. That is from the summit, a labor expert at the University of Indiana in Bloomington. All these states where they have had strikes, it's also illegally said, and if conditions get bad enough in the workplace, they will indeed strike. Indiana ranks 31st for the average teachers pay around $50,000 according to the National Education Association. In West Virginia and Oklahoma, the average salaries are $45,000, ranking 48th and 49th. Nothing to write about because we have had some collective bargaining. This state is one reason we are not in as bad a shape as Oklahoma and West Virginia. Labor leaders called off a Molly Day. This is in Oklahoma. Last month, the Republican legislature did, in fact, raise salaries there about $6,000. So some of the things going on here in various states, and now it is spread to Indiana. Now, you're talking about politically, won't go into much of it here. These are very red type of states. Let me just get in the cost of. We used to be at Jobs at Peace, now no longer there, but you just wanted to get in this little thing from Fortune magazine on the cost of the missiles, and I'm not certain if this is just the U.S. costs or the total cost. We'll get to it in just a second here. I can find it. Normally we have these queued up, but I had to go to a different work station here. And anyway, we'll get there. We'll edit out the space there. So we'll edit. Unix system, as we're on, it's very, very similar to what you see on a Mac system for those that want to play along at home. Or maybe we have disappeared. Yeah, we had it up. I guess it has disappeared. It was the cost of these strikes. Yeah, sometimes this happens. See if I can find it. Well, we'll do full employment. Anyway, it was $5 billion and counting. This is from the Washington Monthly, the mirage of what they call full employment here, and it is by Ann Kim on the 13th. For the past several months, Republicans have been resting on their laurels of positive job growth and low unemployment. Proof they say the economy is working. In March, the nation's official unemployment rate stood at 4.1%, the lowest it's been since the peak of the Depression. No doubt about that. Certainly on paper, the labor market looks to be as tight as during the past expansions. During the booms of the 90s and the 2000s, in reality, however, the lower official unemployment rate masked some of the serious weaknesses. This is our part right here in the economy. Rural job growth, for example, is lackluster in comparison with that of the cities, while college graduates and other highly skilled workers are in demand. People of color, less skilled workers, are still struggling. The share of people actually participating in the labor market is significantly lower than the past, including amongst, we've talked about this before, prime age adults. Those are the ones of 25 to 54 who are the backbones of the market. Not much backbone there. Put simply, fewer Americans are working or even looking for jobs. This means the decline in the jobless rate reflects, to some extent, a shrinking pool of Americans looking for work. In March, for instance, the total share of Americans participating in the workforce were more than 4 percentage points lower than it was in 2000. The employment rate was lower as it was today. And they have the labor force participation rate here. The share of prime age adults in the workforce is also down by more than 2% compared with 2000, that'd be 18 years ago. Decline in the workforce participation rates, in fact, the biggest change that must be solved. Full employment will ever be achieved. Well, that's sort of a myth right there. Some analysis attribute, and we'll put this on here, won't go into all it, we'll go by. In rural America, for example, are facing less rosy job prospects than in urban America, at least 2 of the past 5 years. Rural areas are, moreover, suffering from a double whammy, higher than average unemployment rates and lower work participation rates. For instance, the official jobless rate stood at 5.4% at the end of Q2, that's in 2016, compared with 4.8% for metro areas. The USDA estimates that the unemployment rate has been 7.8%, has the participation rate, has the workforce participation rates been in 2010. Cities, in contrast, are booming. Regional inequalities there. That is from the Bureau of Labor Statistics. In 338 metro areas saw gains in job growth last year. More than 24 cities report official unemployment rates of less than 3%. The biggest winners were predictably places such as New York, Dallas, Los Angeles. Each are adding 100,000 more jobs last year. Workers without a higher education are also failing to prosper in comparison to better educated people. In March of 2018, the unemployment rate amongst workers with bachelor's degrees was just 2.2%, about half the rate for workers with high school diplomas. And that is an oxymoron anyway. So we'll put this up. For African American men, another group that could and should be doing better there. In March, the unemployment rate amongst African American men was double that of Europeans, 6.1% versus 3.3%. Again, the true story of unemployment in the population ratio, which shows that although both groups are seeing declines in employment, the lack of work is far more pervasive amongst African American men and amongst prime age men in particular. While 87% of prime age European men were working in March, the equivalent figure for African American prime age men was nearly 10% lower at 77.6, which I say is progress. So we'll put this one on here. And Kim is Director of Domestic and Social Policy at the Progressive Institute in Washington. So we'll pinch this article here, and we will go merely back to where we were, to Reuters and the BBC. Incidentally, the BBC has changed its format. I don't like the new format that we unfortunately have to use. Here, BBC has a big, let me just check over with Reuters here Make sure I hasn't missed anything. Wells Fargo, we'll throw that in. This is from Reuters. Faces $1 billion in fines for abuses. Their CEO says that there could be more abuses out there. We'll see. U.S. bank executives see delayed boost from tax overall. That's a sort of a mixed operation there as to where it is going and not going. We'll take a look at this. The Wells Fargo situation there. Wells Fargo, $1 billion in fines here for automobile insurance mortgage lending. This is a pretty corrupt enterprise here. Reported a quarterly profit and said it may have to reinstate results to reflect the future settlements. Shares of the bank fell 3.4% to $50.89. Operation of Wells Fargo could recover, but reputatively and how $1 billion will weigh on them, and only time can tell. That's from Art Hogan, chief strategist at B. Riley in Boston. Analysts say that the $1 billion penalty may not be a significant dent to the balance sheet. Well, it could be more than that. The bank is still smarting from a prolonged sales scandal and found inconsistencies in automobile lending and mortgages. This has revolved around this criminal enterprise. Estimate restrictions on balance sheet growth will cut an annual profit by anywhere from $300 to $400 million. The chief executive Sloan repeatedly sought to assure people he lied. Despite its ongoing woes, the bank reported a 6% jump in profit, saying net income applicable to common stock rose at $5.35 billion, or $1.12 per share. So in other words, they're still making money, no matter how much the shenanigans are there. So that in itself, I guess we took care of Wells Fargo. Anyway, that was Wells Fargo. We'll go back to the BBC. A little more from the we'll just get this one. This is back again to rural America and how it will affect that particular sector of the economy. Who is losing out from the Trump tariff programs? This is from the BBC. Incidentally, Jaguar will shed 1,000 contract workers. More adjustments, and that's, I assume, in the UK. Just look at it. Tariffs of $50 billion worth of each company's products are offered as administration. Economists expect the dueling taxes to have a relatively limited impact on the overall economy. They say the measure will touch most parts of the country and lead to higher prices from everything to televisions to vitamins. That's kind of interesting there. A lot of companies that import vitamins or vitamins, what you want to call them, from China. Some firms and measures are welcomed. Companies such as U.S. Steel announced plans to expand their operation, bringing on hundreds of workers. Their customers, many of their manufacturing locations in the Midwest, are worried, however. They say the tariffs will also increase demand for domestic steel, which accounts for a majority of the sales in America, driving up the prices for firms reliant on steel parts. Big part of it there would include taxes on hundreds of Chinese-made parts and equipment. And most of you don't hear about that at Roadtech, a growing 600-person company that's in the state of Tennessee that makes asphalt paving machines. Suppliers are already asking 40% more. That's according to Eric Baker. He said the firm is still trying to figure out how to best address the higher costs. And so this is going on here already. So they've jumped ahead. The tariffs at 25, they want 45. Hundreds of firms have asked the Commerce Department for exceptions from the steel and aluminium of aluminum tariffs, including Wisconsin-based Seneca Food Corp. The firm makes its own cans to support a large fruit and vegetable processing business. Meantime, Chinese shipments for orders of 11,000 metric tons priced last summer is due to import the next few weeks and face a new 25% markup. Wisconsin, the source of more than 90% of U.S. cultivated ginseng, and that's kind of interesting here, but they make as much ginseng there. Can't afford to lose access to the Chinese market. I take ginseng, a lot of us do. Of course, we take Korean ginseng. Has been a key buyer at ginseng since the 1700s and is destined for more than 3/4 of the state's trial. I didn't know that. I suppose next time I visit Wisconsin. About a third of the soybean crop heads to China. That is 14 billion there, but Argentina and Brazil are also large exporters. They'll pick up the, as they say, the slack, what these characters leave behind. Greenland America, a brokerage that buys and sells scrap metal, another scheme. So far, he says less than 10% of his firm business has been affected. And, you know, it goes on and on and on here. Value of U.S. exports to China. We'll have to pinch this one up here, and we'll put it on our official Twitter feed, which we hope it will be going to. Is that, well, sometimes things don't work out right here. Anyway, we'll get back to that. Go to the market data. This is what I was talking about here. I don't like the way they're doing it. And you don't have the FTSE All-Share either up here. You've taken out some things. Nonetheless, this is the FTSE at 0.33 plus percent here. In Amsterdam, they were at 0.03% there. The DAC, that's in Frankfurt, at 0.22%. And in Madrid at 0.21% there. In Asia, the Syntex, that's in Bombay, we didn't usually do that one, but anyway, 2.70 in the Hang Seng in Hong Kong was down 0.70% there. Nikkei, and I'm assuming these are on Friday, was up 2.55%. And now we have to, the Dow Jones was down 0.50. The NASDAQ was also down 4.7%. And the Merck out in, I think, in the city of Chicago, S&P 500. Anyway, probably not getting what we want here. We're going to have to do some adjustments here to this. We won't mess with currency. In commodities, Brent crude futures up 0.78 are at $72.58. West Texas crude, T-Bill and Pickens jumping for joy at $67.39, up 0.48%. On the Forex, no change there. Gold at, and we don't get to buy. I really don't like this. I'm going to have to find some other place to go. At $1,345. And we don't have the Bloomberg Commodities Index. So we're going to have to, as they say, look around for some of these different items here. E equals MC square, economics, 2010, is our official Twitter feed. Probably won't be able to. Nonetheless, just looking at some of the sectors here, this is from Reuters. Financials were down 0.58. Healthcare was down 0.15%. Technology is down 0.30. And telecoms were also down 0.16. And utilities were actually up at 0.48. We're going to have to hunt these down, which we shall, like the Bloomberg Commodities Index, those sorts of things. we'll get all of that information here, but it will take. Go to Bloomberg here. There's an article here that's kind of interesting. We'll do this on the political thing. It's business as usual for Syria's Assad after the attacks. They show a picture of President Assad walking into his office. And that's about it. And we go to Bloomberg Markets maybe. We'll have to figure this out. It's going to take us a while to do that. We'll do it later, actually. Another headline, NAFTA agreement could come in weeks, according to Mr. Trudeau, the French Prime Minister. Another headline here, the investors are not quitting the market yet. Stock volatility is set to spread. We'll see. Each week of the last few weeks we've talked about the VOC. That's the volatility index. I'm not sure. JP Morgan Chase was bemoaning its Friday earnings call. Stock volatility can help reignite fixed income currencies commodity trading. The State Street Corp was a warning there. Swings in equities creeped into the market. That is from Lee Forage, head market strategist at that particular place. On liquidity, the real force for me has been the second half of the year. Focus, which will actually record a net drain in the European Central Bank. Looks to wind down its bond buying, a quantitative easing, Ford said. JP Morgan's adjusted revenue for fixed income currencies and commodities about the same as last year. So we have a number of things happening here, and I don't know if we can sneak this one in quickly here. Probably can't. But nonetheless, a lot of the activity as we started our report here is yet to come. And it does take a little while for the stuff to filter in. And it is starting to filter now. The big question is how quickly will it filter in? In other words, we're just in Q2 now. Usually these things don't happen until Q3 and sometimes Q4 of a year. And if it comes in much more quickly than that, we could be in, as they say, for a long, hot summer. Now, petrol prices, we haven't seen any gains on petrol. As far as petrol is concerned, we haven't seen very much. We've seen declining prices. And of course, again, it's the American economy is not a balanced economy. We see rural America hurting, and various other small steel plants. The U.S. steels of the world, they would do better, yes, but even employing hundreds of workers, they're not employing thousands of workers. These smaller plants have another effect on these rural communities, so we don't really solve that problem. But again, the big question is how much these communities will actually, in the scheme of things, I hate to say it, matter. And that's always your big question out there, what the percentage is of these enterprises for the overall economy. And that is something that we'll see in the future here. And I'm just looking at some Bloomberg statistics. And we did a Nikkei, Hong Seng, we did it. And this is from Bloomberg. I'm going to have to cheese down the Bloomberg Commodities Index and for future broadcasts. We'll have that in order as we had it in order at one time for the BBC. Maybe the BBC will go back to its old format. We'll have to send them a little letter to actually, an email I should say, to actually see what is going on there. And we don't have anything right now that tells us where we are. nonetheless, this is a good juncture to end our broadcast here as we move in much of the nation also. Let me make this note. Climatic conditions are not good. Baseball games are being postponed in places like Minneapolis. They played in Chicago. Very good game, incidentally. The Cubs are down, 8-2, 10-4 or whatever, and ended up winning the game by 4 runs. You'd say an utterly impossible situation. Well, nothing's impossible for the Chicago Cubs, but they were playing Atlanta early in the year. So that in itself, one just does not specifically know what is going on, as they say. I don't want to equate baseball with climate conditions, but climate conditions are down. There's no doubt about that. The global warming / climate change, cooling, we have that. We have subnormal temperatures from Boston to Montana and various other places. And these all affect, they don't affect the winter apparel business because everyone has already bought those things, which some of them probably running out now trying to find. I remember one spring, later winter, I suppose, trying to find some gloves, and none were in town. Everybody was moving to shorts. But those things are some of the items that are coming, and of course, obviously, delay in spring / summer apparel, and the retail market has really been hard hit. And you see the answer to this. Walmart, for example, is expanding into India. This is the whole concept of global markets. Marx first talked about this. In the capitalist economies, they need to continually be expanding. This is why you hear the rhetoric about free trade, etc. Well, when you get into a nation Pacific, like America First, you'll have these tariffs on there. And you have to look at what short-term effects are and long-term effects. Now, short-term, yes, you're going to have adjustments. But the 40% rise we were talking about in pricing, that is, for now, a sticker shock there. They're trying to work it out. But on the long term, where will that actually go? Will these manufacturers of beer cans or whatever in cans, they can't go to the American market because that's not what they make. So they have to go to other markets or absorb the cost, which the ripple effect across the American economy for people that buy those particular products from this firm in Wisconsin. I think in juice, whatever they were selling there, even the ginseng market. So in other words, all these things have effect, and as they filter into the economy, there is more inflation, which they will adjust out the inflation, but that pushes up the borrowing costs, which will affect the so-called loose change market that Wall Street and the banks are working on. You have to understand that these are exceptional reasons. You don't have quantitative easing because the economy is working at 100%. Absolutely not. You don't have these stimulus programs such as tax cuts if your economy is working normally. It's the last thing you want to do, because then you push up your deficits, and really the only option is after you run your deficits up, you have to cut your social spending, which affects the whole economy, particularly parts of the economy in rural and urban areas. And then you have a mixed bag. Your healthcare costs there are having more and more people that literally are dying in the streets of America. And that turns into an economic problem. And even people that can get medical care through hospitals, ERs, etc., are dying because they have to go back out in the cold. So in other words, all these things are affecting the overall economy. Not necessarily big effects, but they eventually have cumulative effects or side effects. And those things eventually are frightening to Wall Street. And then you have the tech enterprises that they sort of prop those up. Facebook is in a lot of trouble. They don't talk about that, but they actually are. and the whole ad mechanism, whether it be Facebook, be Google, etc., over privacy. And you have to note that most of the market for those people, at least the expansionary market, is outside of North America. And that is the big problem. And at the same time, you'll have other offerings that will be a Facebook or a Google. In, say, China will move into the space where these characters are. That'll do it for us. For those in business, have a productive week. The consumer, keep your eyes on the prize. And check out our offerings on the Bostonred Network, where would be our political program, Bostonred. It was around before the network, incidentally. The Open Source Report, that is our technical outlet. We talk about open source software, hardware, security there. We partner there with Crescent Software. And as with this program, we partner with Crescent Analytics, which you can go to Crescent.com and find our programs now that are not already there. They will be there from iHeart and from some other outlets that we are on.